Hello, welcome to our channel, Value Investing Rutherford. Now, here we talk about value investing and investing in equity as an asset class. So, first of all, when we talk about equity, many things that come into our mind that what about the risk factor, the volatility, and the loss making risk that we can encounter in our investing process. So to tame down this kind of negative inadvertent thought when we talk about investing is to deep dive into the concept of investing. Now the concept of investing is that when we are purchasing the shares of any company, actually we are not purchasing the shares of a company. We are being partner with the owner, the promoter, and the key managerial personnel. A business has a legal entity. It has its own plant and machinery. It has its own employees. It had its own business roadmap, which it carries down through its employees, through its managers over a period of time. It generates some revenue. It incurs expenditure, and in the statement of profit and loss, we can see the result is a profit or a loss. Now, when a company incurs a profit or have a profit, it distributes it by way of dividend, which the shareholders can get sitting at their home without having to work at the factory floor, in which we can compare with our job where we have to work day and night depending upon our position in that company, the responsibility in that company. So in equity we can say that it's a blessed business. Once we get a know-how of the company, that whether its capital allocation perspective is appropriate or not, then we are very much well affirmed of our action and the rational response that we can expect going forward. So the basic thing that we need to understand is that equity as an asset class is not only the shares that we purchase from the recognized stock exchange of India. It is all about being a partner with a very great business or a great businesses when we build a portfolio, so that going forward the management has the responsibility of corporate governance and other regulatory issues that they can deal with very well, given their workforce, given their proficiency in what they do. So once we get hold of those understanding, those issues, that how the company operates in various business facets, it works in through its supply chain management, through its synergies, through various kind of regulatory approvals and so on, then we will be able to make sense to our equity investing. And the most important part is that we are not here, when we talk about investing in equity as an asset class, that we are not here for doing a speculative activity. For example, we purchase any particular share of a company and we expect that tomorrow we will sell it and have a quick gain. So there is no shortcut in success. So if we look back around ourselves in the environment of investing in particular, we will encounter various successful investors who have made their fortune in Indian context and also from the context of the abroad. Those investors, if we look down about their philosophies, they will always uh, advocate the philosophy of value investing. So when we understand a business, its intrinsic value, and then we go on and purchase a fraction of that business through equity investing from the secondary market, we can expect that that will help us in achieving our financial freedom going forward. So in a nutshell, we can say that we have to follow the law of the farm. Now what is the law of the farm? That we cannot sow a seed today and reap it tomorrow. A seed has to go through all the season before it is a fully blown up tree. So same is the case with investing. Here, if you have your risk appetite appropriate, your time horizon, your patience, then you can expect a good amount of return and a good amount of wealth going forward. And once that mindset has been prepared after a considerable period of time, then it's a blessed business in our sense. Because in a job or in a business that people pursue, there we have to work on the floor, deal with various regulatory issues, compliances, and many other things. But in investing, once you know what is the credibility of the management, what is the fundamentals of the company, what are the analysts viewpoint, how the results are coming, whether the revenue is growing or not, whether the company is having a growth or not, then you are amply clear about your background work, that whether you should go in and have a partnership with the particular management. So keeping those things into perspective, there are certain facets. Of course, this will take a considerable period of time for a newcomer to understand and then put those philosophies into act. But that is worthy, because if you are committed to generate certain extreme, stupendous amount of wealth, then as far as history has suggested us, that equity as an asset class is the only way where you can make tons of wealth, provided that you have the correct perspective and the correct knowledge about the management of the company, its product services that it is delivering to various customers, whether in India, indigenous or export oriented business. So the main thing is about understanding the economic characteristics of the business. So when we talk about understanding a business and understanding the economic characteristics of the business, the prime source is to have a very good understanding about its fundamentals. Now, fundamentals encompasses the financial statements of a company, where we have these balance sheet, statement of profit and loss, cash flow statement, and notes to accounts. So these have to be understood in great detail, and when you understand them in a reasonable sense, then you will be able to understand the capital allocation perspective of that company, that whether it is having too much amount of debt, instead of having its free cash flow into play, and whether it is determining its debt equity ratio properly, and whether it is being able to uh, comply to the debt covenants. And the other perspective also holds true, that what are the debtors turnover ratio, what is the inventory turnover ratio, what is the working capital ratio. These are all the very basic things. Now as we move on and dive deep into the philosophies of investing, as far as fundamentals are concerned, there are many other things to be kept into consideration, such as owner's earning ratio, then DCF, how to compute the intrinsic value. Now, when we talk about a profitable investing philosophy, then we must be very careful that whether we are into the euphoric moment or we are in the pessimistic moment. Now, the beauty of investing stands with the being a rational contrarian. So it's a very typical term, and is it encompasses various different concepts of investing, that at the same time you are a rational human being and you are contrarian to the other euphoric market participants. So that takes a considerable period of time to build that philosophy, but once you build it, believe me, that is the right way of approaching the investing as far as value investing is concerned. Now, in the field of value investing, there are certain inadvertent scenario which poses certain biasness, or I would call it technically the heuristics in behavioral finance language, that precludes us from taking the right financial decision at the right time. So today we encounter various media, various newspaper, various channels, various telegrams, and the market participants are large, those who are busy in that kind of conversation, that you have this, you sell this, you have this, you buy this. So when you encounter such statement, the first thing that you should answer, that suppose if I don't own any particular share of this company which the other market participants are proposing to buy, is it making a real sense, taking into consideration valuation factor, taking into consideration the business perspective, taking into consideration various other scenarios, whether the taste and preferences of the consumers are changing in nature. So these are very basic, simple things, but as you go along, you will see that there are many things that people and the market participants at large try to make things complicated. Now, there are various things where mathematics comes into play when we deal about financial statement, when we deal about balance sheet, when we deal about profit and loss cash flow statement. Now, basic mathematics can help you to understand and have a torchlight before you, so that you have a basic understanding about where your company which you are analyzing is about to go. But the most important thing that needs to be taken care of is what is the euphorism that is going on. The moment you encounter euphorism, you see that the company which is available in the secondary market listed on the recognized stock exchange, it's available at a very high valuation, whether in terms of your P, whether in terms of your PEG ratio, whether in terms of your DCF valuation method. So at that time, we have to be very cautious in those kind of sectors or those kind of specific companies that the market participants are ready to pay anything to acquire their shares. Instead, where we should focus upon, there are certain pockets at every given point in time, whether we are in a bear market or we are in a peak of the bull market, there will be always some pockets where the market participants are not having their attention towards. So these pockets may come in handy if you go and analyze their financials, because a very good company in the moment of a temporary problem can make you extremely wealthy over a period of time, provided you understand the business well, you understand the economic characteristics well, and you can value the intrinsic value of that particular company. So if the intrinsic value per se, let us say if it is 100, and the market is offering that company at 200 rupees, then of course it's double the intrinsic value, and you should stay away from that particular company at that point in time. It may be a great company, but it may not be a good stock at that point in time. So on the other hand, if you see the intrinsic value remaining 100 and the market is offering you at the rate of rupees 50, then you are getting a straight away 50% discount. So these are the time when you should look at a very good company with a great product line, has a pricing power and has a moat, so that even if you go wrong little bit in your computation of intrinsic value per share, then also it can't stop you from having a good amount of money, provided the company is following good corporate governance. So keeping all these things in mind, one conclusion that can be drawn is that if you are indulging yourself into the basic nitty gritty of investing, analyzing a company, knowing the management, knowing the product line, and have patience and have a good time horizon, then you are bound to make a great amount of wealth. Now, coming to the time horizon, what should be the adequate time horizon when we talk about equity as an asset class? The time horizon has to be 10 years or more. Anything that is less than 10 years had a biasness towards speculative activity. Now, 10 years is a ballpark figure that I can tell you. It can be infinite also, because if you know that you have deployed a particular amount of capital in a particular company, X amount of capital, then you know that capital has an opportunity cost. Since you have deployed that capital into the plant and machinery, into the workforce, into the product oriented, into the delivery of products and services that the company does, that means actually you are also incurring an opportunity cost at that point in time. Now, is that opportunity cost justifiable from the company's viewpoint, like the way it's performing? That will be shown by its annual report, year on year earnings. So if you can track that and have a good understanding of the conference call that every good company hosts over your website, and it's also available on YouTube and various other digital media nowadays. So once you go through all the nitty gritties of the investing, then you know that it's a good company and you can bet upon it. So the other thing that comes as a second step is about patience. Now, even if you have dealt with all the nitty gritties of investing in the first place, and your research work, your background work for identifying a good company with a good capital allocation, with a good management, and so on, then also it may take a considerable period of time for the market to reward that company. So, as Benjamin Graham says, that in the short run, a company or a market to that extent is a voting machine, and in the long run it's a weighing machine. So in the long run, if the earnings are growing, if the revenue are growing up, if the other facets like debt equity, and the other balance sheet reserves, retained earnings are doing good, then market has no other option but to respond you handsomely because of your investing. So there can be ample amount of examples that we can look back in the history of investing about great companies. When they were small, they became mid cap, and then they become large cap. So in investing, it's not about grabbing the next multi bagger. It's about choosing the right business which you understand. And when I talk about understand, again, it's all about understanding the economic characteristics of the business. It's understanding the product of the business. It's about understanding the services of the business. Now once you are done with those things, and that's a continuous process. Every annual, I mean 12 months, every 12 month financial year ends on 31st March, and then you have the annual report. So you have to go in depth study of this annual report of the respective places within this annual report. So you will get a sense that whether the expectations have been met, and if you compare those actual facts and figures stated out in the latest annual report with uh, the last couple of conference call and the last annual report also, then you can have a sense that where your company is headed towards, and whether the management and the trustee in the form of board of directors are doing their work or not. So it's all about staying a bit ahead of the crowd, because crowd, when you talk about bull market, it's all about euphorism, unnecessary euphorism. And when you talk about the bear market, it's all about pessimism. But neither thing is bad or good, but what you do out of that pessimism and optimism or euphorism, I would say, is makes you a good investor or a bad investor. So a good investor is one who can control his emotions with regard to financial decision making and put various heuristics under their control. Now, I would come up with a separate session of value investing and certain behavioral biases which dodge human behavior into taking a good financial decision in the real life. So there will be a different kind of series, and I will also come up with different series of Benjamin Graham which he has brought about in his various books, so that I can refer to them and explain to them and discuss with you all about various facets of investing and how can we move along from this point in time. So always remember, volatility is our friend. It always gives us opportunity, both in terms of buying and selling. And when you buy, you are not buying a piece of a share, but you are buying a piece of a company. You are partnering yourself. That I stated at the outset, at the beginning of this video. So very soon we will meet with the series of Benjamin Graham and various philosophies of value investing and behavioral finance. So this is a process of continuous learning. When we talk about investing, it's not that it's not a course where you have 3 years into study and then you get a degree after giving an examination. It's not about that. It's about creating wealth and being rational. Your response should be rational and very imperative as far as the performance of your own company. Now there are many other things regarding constructing a portfolio. So there is a very frequent question that comes from the investors community, that they are confused with how many stocks they should own, or how big the portfolio should be, or how much concentration the portfolio should be. So these are all very big discussions, but in simplicity, if you understand the cost of your capital, or more appropriately the opportunity cost, then you would be very wary of taking your punches towards your life and towards decision making. The less number of decisions you take and the time you devote to taking one decision in terms of equity as an asset class, then you are much more having a chance of making a great wealth, as opposed to the fact that you are taking frequent decisions of buying and selling. So this discipline will only come when you understand investing in investing sense. And believe me, no academic degree can give you this kind of understanding. Of course, there are basic academic degree that you require for understanding the fundamentals of a company, but after you have achieved a basic fundamental degree, then it's all about the understanding of the balance sheet, your dedication, your contribution towards your knowledge base in yourself, and devotion towards this subject. The more you are devoted to this subject, then you will gain more knowledge, and with more knowledge you will be enthusiast in understanding various facets and various integrity of the investing. So here I will end this video with this particular note that, again, we have to follow the law of the farm. We cannot sow a seed today and reap it tomorrow. So be patient and don't jump for quick money. Going forward, if your approach is right towards the market, when it will reward you, it will reward you very handsomely. That time cannot be said. Nobody knows the time when you will be rewarded, but your approach is right, then you are certainly there to make a good amount of wealth. So with this I end my video, and very soon we will meet with this concept of value investing and behavioral finance, and various concepts that has been discussed by Benjamin Graham through his various work throughout his life. Thank you.